Very good evening, friends, for joining us today. As you know that we are celebrating 4th October as the World Financial Planning Day. And yes, as an initiative, we have invited Mr. Resham Jain. Now, he knows best of all the worlds. So, like if I have to say something about him, probably I need at least an hour to describe who Resham Jain is. But yes, briefly, I'll definitely introduce him because you also should know how his journey has been so far and why he is the best person to be here with us today. Resham Jain is a very popular academician. Very few people know about it. So he started his academic journey actually. So he started his career as an academician. He has worked with ICFA University. Then uh, he has his own venture that is called Ahmedabad Institute of Finance. Then he also played a very important role uh, in Anagram Knowledge Academy as a pioneering member. Then, yes, of course, he has been one of the most popular and charismatic faculty I've ever seen. But his interest in financial markets and corporate finance made him join Arvind Limited. He has worked with the Hill Project also. After that, he has joined B&K Securities. He has joined DSP Mutual Fund in 2016, and since 2018, he's managing the most popular small cap fund, that is DSP Small Cap Fund. Also, like if I let you know about his academic qualifications, it is absolutely impressive. He has cleared CFP examination in 2009. So is the reason he is one of the best person to be here with us. Apart from that, he's CFA India, he's CFA USA, he has cleared FRM examinations, and probably he would definitely like to add a couple of more degrees with him if time permits. He's a very busy person. And yes, on our request, he has been here. Definitely he is off the office hours, right? He has spared some time for us. So I'm not taking much time. I thank Mr. Resham Jain for being here with us to share the deep knowledge of stock markets and wealth creation through equities. That is the topic he has given to us. We are celebrating one World Financial Planning Day today. And whatever questions you have, eventually you can definitely let me know. You'll directly text me your questions. So at the end of this session, I'll ask Resham Jain to answer your questions. Fine, so I hand over to him.
Hi, friends. I hope I'm clearly audible. Am I audible?
Yes, you
Yes,
are
sir.
very well audible.
Okay. Thanks. So thanks for inviting. I think it's a very important day. I think the financial planning day, or I think it's a unique celebration. All of us in financial services industry should celebrate this. Not only just for our own careers, but I think generally for everyone's benefit. And I think Prashant has been a great friend. We have been knowing each other since last 16, 17 years now. The initial part of my academic journey we had together almost for initial 6, 7 years. And obviously I decided to get into corporate finance, and I kept changing my profession. I think a lot of you are studying currently, and it's very important to understand that changing profession is not difficult. Uh, you should not have a baggage in your mind that it's difficult to move from one profession to another until you have your own kind of motivation within that I want to shift. I think it's not difficult. So I think today what I wanted to share, I'll just share a presentation, small presentation, just to convey some of the important topics. But just let me know whenever it is visible. I hope it should be visible now.
Resham, you are a host right now. Just sorry to interrupt. If some participants are coming, you keep adding them.
I'll admit them. Yeah, sure. Okay. Is my screen visible now?
Yes, sir.
Okay, superb. So basically, what I wanted to share, and I think this one slide will give us a lot of learnings about market cycles. This is nothing but DSP small cap funds NAV chart since last almost 16 and half years. And particularly, I have highlighted the drawdowns in this last 16 and a half years. It has seen various cycles over this period. As you know, it started its journey in 2007, probably the one of the best bull market in capital market history. And in initial year itself, it has given more than 60-70% return. But what happened in 2008 became the most important topic for academicians. And you can see the first drawdown during that period was as sharp as 70%. And that happened just within a year's time. Not even a year's time, it's just 8-9 months' time. So a 10 rupees NAV went to like 16-17 rupees and came down to 4.5. So you can see on the top here, the low NAV was 27th February 2009. It went as low as 4.57. And then obviously market did recover. But again, if you look at 2011, we had this taper tantrum in US. And during that period for 4 years, 2011 to almost 2000 and early 2014, market actually fell by almost 24% for 3 years. So actually we didn't make any return. And then the one of the very great bull market started since 2014, and it gave phenomenal return. But then obviously it went up so high that 2017-18, before COVID itself, we have seen more than a 20% kind of correction. And COVID obviously led to another 30% correction. So almost 50% correction. But interestingly, if you'll see 2020 to 2015, the market actually was flat in a way. Whatever it gained from 2015-16 till 2020, practically market gave up everything. And then obviously since 2020, we saw another great bull market. And so basically what I'm trying to say is that market is not straight. Market will have its own reasons to go up and come down. And market commentators will keep making commentary around it that this led to fall and this led to rise. And obviously there will be reasons. But journey will not be smooth. Journey will be with a lot of volatility. But what is important is if you stay in the market for a longer period of time, you make good money. And the time period is not very, is not known in a way. Whether you will make money in 1 year, 2 year, 3 year, 5 year, 7 year. I'll share the kind of returns one can make if one remains in the market for a fairly good period of time. But this 16-17 year journey, if one looks at, then the CAGR return since inception till 31st August was almost like 18%. And if one would have done an SIP, which would have weathered all kind of volatility, then the return would have been close to 21%. And if one would have done direct plan, one would have saved some of the expense ratios, so close to 22-23%. But if one would have not shown this return, then just looking at the chart, it seems that there will be huge volatility which is there in the market. And what I wanted to share is that this one graph teaches us a lot of financial planning concepts, which all of you guys have already learned, read, and experienced over a period of time. So there are a few important financial planning principles or within equity specifically, which one should be aware about. One very important is discipline in savings, which all of us know the importance. And wealth doesn't get created in a year's time. last 2-3 years, those who have entered in the last 2-3 years would have thought that it's so easy to make money in the market, but it has never been so easy. What is more important is you keep saving and keep investing over a longer period of time. So discipline in savings is very important. Um, Second very important thing is patience during volatility. So along with a lot of these financial principles, the other important principles one should learn is behavioral principles. There are a lot of great books written on behaviors, and one should definitely read those books. And it will help us to understand. Sometimes we get so biased by certain aspects of our life, and that make us think that certain things will happen in certain way only. But one of the important principles of financial planning is you have to remain patient, especially during volatile times. Third, very important is you can't time the market. Would someone have thought that in 2008 will market fall by 70%? In 2007, if you would have asked anyone, I think people would have said things would go up another 60, 70, 80%. That kind of bull market was there at that point of time. So similar is current period. And I don't know whether market will go up or go down from here on. But I know that if I remain in the market for next 5, 7, 10 years, then definitely I am going to make money, irrespective whatever volatility comes during that period of time. So time spent in the market is very, very important rather than timing the market. I'll explain there are periods when timing also helps. But yeah, I'll explain that at the last. Fourth, very, very important looking at this graph is goal-based investing. All of us have learned about it, but why it is important, just looking at this chart, is because let's say an individual might have certain goal which are to be achieved, let's say in next 5 years, 7 years, whatever period, 1 year. Markets are volatile. So if your capital is going to get eroded by, let's say 20, 30, 40%, whether it will hurt your goals, which are, let's say, short-term in nature. So if someone is investing in equities, it's very important that one has to be really long-term. There'll be phases like, let's say 2010 to 2013, when actually market has been minus 25 to 30%, which means that you're not only you're not able to beat inflation itself, and you are actually losing money. But yes, if you have stayed for another 1 year, then obviously your return would have been much higher. So staying in the market is very, very important. And your goal has to be aligned with the kind of product you choose. So equity is that kind of product. Another important aspect is prudent asset allocation. And this is something I can say slightly different from the third concept, which is time. Because let's say in a market which we have seen in the last 3-4 years, if someone has invested and their asset allocation has moved between equities and debt, I'm sure a lot of people equity proportion might have increased, and debt proportion would have gone down just because market has moved up. And reverse would have been true if market would have come down. So it's very important that based on your goals, you keep reallocating some money back to debt and equity. So I'm not saying that remaining in the market is not important, which is time, but at the same time being prudent enough to reallocate capital whenever market moves up and down. So that's again very, very critical. And the most important aspect is being greedy when markets are down and being fearful when market goes up. And that makes you do this fifth point, which is asset allocation. So I think this chart teaches us a lot of things. And I think not this NAV chart, but any market price chart, you should always keep in front of you, which can be of 15 years, 20 years, 30 years time frame. In US price charts, you can see for last 70, 80 years. And it teaches a lot of important principles in financial planning. And hence it is very, very critical to be agile in the market and to remain behaviorally aligned with the basic financial planning principles. So that's what I wanted to say, just to start the overall discussion.
Now, this is the question from Janki. Now, what she's asking is, how do you differentiate between buy and hold and cut your losses soon when it comes to long-term investments?
Yeah, I think that is what I spend a lot of time on patience, and that is what I associated it with laziness, because and that's why it's very important to write your thesis when you buy a stock. In fact, anything which you do, you have to write it, and you should have the ability to revisit it whenever you are in doubt. So what we do is we write a thesis of a company whenever we invest, and whenever that thesis is breaking down, then I think we don't look back. We just exit those positions, even at losses. And that thesis can break down because of multiple reasons. It can break down because of, let's say, business model. So let's say, as you mentioned, that AI is an opportunity, but a lot of traditional businesses, AI would be a threat. So if a business model is breaking because of that, and I am able to see that happening quarter after quarter, then I have to cut my losses in those cases. Or many times when I have invested in the company might not have made any capital allocation issues, or they might not have done anything where I would have any issue. But once I've invested, let's say 1 year, 2 year later, they might have done certain decisions which might not be good for minority shareholders. So I have to take decisions accordingly. So buy and hold doesn't mean you have to be passive. Buy and hold means you have to be proactive in evaluating your decisions and keep revisiting your thesis. So it's very, very critical.
Thank you so much for joining us today and stretching your day like anything. We have taken a lot of time, but our students have learned a lot. And definitely, I would admit that if you can, sometime, if you have some spare time and you join us for taking the session, like academic session for our students, will be more than happy. Students will
No,
definitely.
I'll be more than happy to do that. I think there's a great field to be in. I keep telling a lot of people about the importance of financial planning, and I think this is one sector where it's an annuity model. Very few businesses have that opportunity to build an annuity model. So you build something, and if your clients and customers uh, keep remaining with you, you will keep earning money along with them, and keep growing along with them. Because if they grow, they'll do more SIP. They will have a higher AUM with you, and eventually. So I think hard work in initial years will keep rewarding individual financial advisors and planners over a long period of time. So it's a great industry to be in. We also have few of the wealth management companies in our portfolio, because there are very few industries which will keep giving you compounding returns. So there's a great industry to be in.
Fine. So now, if any questions which may come up to me after this session, I'll definitely forward to you. So they'll be happy to have that answered from you. And you being here means a lot for us, right? Students probably have met the fund manager. Many of the students would have met the fund manager for the first time in their life. So it's a great experience.
Great, thank you. Same here. I think I love interacting with people, so it's a great opportunity for me as well. Thanks.